I made over $2,000 from concentrated liquidity pools alone in the month of November of 2023. The best part is I made an additional $7,000 from price profit, meaning with concentrated liquidity pools, I can retain exposure to my underlying assets, the assets that I truly believe in, while earning a substantial amount of money on those assets. So with that being said, I'm going to break down exactly what concentrated liquidity pools are at a high level overview in this video. So the first thing I'm going to mention is Uniswap. Uniswap is the protocol that invented concentrated liquidity pools. They are also one of the first decentralized exchanges in the DeFi space. Essentially, people can head over to Uniswap and as a trader, they can execute a trade. For example, they could swap some USDC for Ethereum or some Ethereum for USDC. As you can see, if I wanted to swap $3,938 of USDC for Ethereum, you can see I'm getting out roughly 1.76 Ethereum, which is roughly 3906. So I'm actually losing a little bit of money to slippage right there. So we could turn off Uniswap X and it'll go directly through the decentralized exchange. In this scenario, we only lose 0.2%. Now, if I were to go execute this same trade over on Coinbase, I'm going to get a substantially lower amount. So you can see if I put in the exact same dollar amount right here, I'm getting 1.75 Ethereum as opposed to 1.77 Ethereum. And that's because I'm having to pay a Coinbase fee of roughly $73 as well as the price spread right here. Now the thing is, I do have my fees waived because I do pay $30 a month for Coinbase Pro, but that is still limited to an extent. And to include the price spread as well, in my opinion, that's just not really fair. So that's where decentralized exchanges come into play. Coinbase is making a lot of money. What these decentralized exchanges do is make a lot of retail users like you and me, as well as big institutions, a lot of money. Because we can allow these trades to happen and we can receive the fees as opposed to a big brokerage like Coinbase or Kraken or any other centralized exchange collecting the fee. And one thing I want to mention is that is not a shot at Coinbase. There are benefits to using Coinbase. There are also benefits to using a decentralized finance wallet or even just using a decentralized exchange. There are centralized entities in this space and there has to be centralized entities in this space in order for people to bridge the gap from real world and take money from your bank account to actual cryptocurrency and DeFi and put money in your crypto wallet. So let's talk about a basic liquidity pool before we dive deeper into concentrated liquidity pool and how it's basically leveraged for your liquidity and how you can earn really good returns like 60 to 80% APR. First things first, there is something called a liquidity pool, and this is exactly what interacts with the traders but also the liquidity providers. So for the liquidity pool, we have two ends. Number one, we have the trader. This is the person trading out of the liquidity pool. Number two, we have the liquidity provider. And if we don't have a liquidity provider, there's no liquidity in the liquidity pool, which ultimately means that there can be no trader. So the liquidity provider is going to put up both assets in the liquidity pool. And you'll notice I said both assets, and that's because liquidity pools contain two assets. So for example, when I was trading Ethereum for USDC over on Uniswap, that liquidity pool is the Ethereum USDC liquidity pool. It has two assets in it. Number one is Ethereum, number two is USDC. So let's just assume this is ETH/USDC, assuming it's Ethereum to USDC liquidity pool. So this liquidity provider is going to put up both assets. So they're going to put up Ethereum and they're also going to be putting up USDC into this liquidity pool. The best part is there is no barrier to entry. They could put up any amount of liquidity that they wish to do in the beginning. If they want to put up $1 liquidity, they can go and put up that $1. I will say it's not going to be worth it to put up $1 or even $10 or $50, but if they want to put up $1,000, $5,000, $10,000, $1 million, they can do that as well. The thing is, there's a science behind finding the right liquidity pools as well as identifying the ranges for these concentrated liquidity pools and determining how much capital you can invest into the liquidity pool without diluting the return you get. And we're not going to talk about that in today's video, but we will talk about it in other videos on the channel, so make sure to drop a like and subscribe. Also, remember, I am going to be dropping a video on how I made $9,000 in the month of November, which is roughly 20% of my overall portfolio. That's a 20% return in 1 month. So make sure to subscribe for that as well. With that being said, we have this liquidity provider putting up two assets, whereas the trader is trading out of this liquidity pool. So for example, the trader might put one asset into the liquidity pool, which if they want to buy Ethereum, they're going to put USDC into this liquidity pool. And then they're going to take another asset out of the liquidity pool. So essentially, they're going to be taking Ethereum out of the liquidity pool. So in this instance, instead of it just being providing, it's providing to the liquidity pool and withdrawing from the liquidity pool, which is known as a trade. So since there's money sitting in this pool, let's just say there's a certain amount of Ethereum as well as a certain amount of USDC. Assume there's $5,000 of each asset in this liquidity pool. When this trader puts more USDC in the liquidity pool, so let's just say they trade $500 $500 of USDC and they take out $500 of Ethereum. So that's plus 500 USDC and minus $500 of Ethereum. Now the balance looks something like this. There's $4,500 of Ethereum in the liquidity pool, and there's $5,500 of USDC in the liquidity pool. Ultimately, what that's going to do is increase the price of Ethereum. And the reason why is because now there's a lower supply of Ethereum in relation to the amount of USDC. And ultimately, that makes Ethereum more valuable and executes an equation within the automated market maker, which automatically adjusts the price of this pool to match the new price based on supply and demand. Now, I'm not going to dive too deep into the equations either, but we can assume Ethereum is going to go up roughly 10%. And the reason why is because there's roughly 10% less Ethereum in the pool. So if Ethereum was at $1,000 before, it's going to be at roughly $1,100 now because there's now 10% less Ethereum in that pool. And I do want to mention that's not exactly what's going to happen. It's going to execute an equation. And it's not going to be exactly 10%, but do take this with a grain of salt because I am trying to be simple for everybody to understand. That's the basis of a liquidity pool system. On the other end of things, somebody can trade Ethereum for USDC, and this is essentially the same exact thing, just vice versa, where there's now less USDC in the pool and more Ethereum in the pool. So the price of USDC in relation to Ethereum is going to go up. And there are arbitrageurs that keep the price of the liquidity pool in check with centralized exchanges, because if they can buy Ethereum for cheaper on the liquidity pool and then sell it for more on a centralized exchange, they're going to go and do that because they're going to make a profit on the spread. Whereas if they can buy Ethereum for less on a centralized exchange, sell it for more on a liquidity pool, they're going to do that as well because they make profit on the spread. So that's exactly what keeps the prices of these liquidity pools very close to the actual market price of these different assets. And for reference, there's over $3 billion in liquidity on Uniswap just on the Ethereum network. When you go and you look at another network like the Arbitrum network, there's $2 billion over there. You look at the Polygon network, things start to get a little bit lower, but there's still $130 million over there. And they have all of these different networks, so Uniswap, being the largest decentralized exchange, has racked up well over $5 billion worth of overall crypto liquidity. Now, with that being said, we can calculate potential returns on Ethereum to USDC or other liquidity pools using a tool called Builder Metrics. Now, normal liquidity pools are considered full range liquidity pools because you're not choosing a price range for that liquidity. You're just simply providing liquidity for every single possible price point as opposed to narrowing down, which I'll talk about why it's better in just a second. But you can see if we provide liquidity for every single price point, we're getting roughly 7% on Ethereum to USDC, which in my opinion isn't too good because you can go stake simple Ethereum for roughly 4% over on a platform called Lido. So that's exactly where a concept called concentrated liquidity comes into play. And the basis of concentrated liquidity is we're essentially selecting a price range for our liquidity. So let's say we have a number line right here, and this number line represents every single possible price point for Ethereum in relation to USDC. So obviously on one end of the number line is going to be $0, and the reason why is because Ethereum cannot go negative. It can go down to $0 though. On the other end of the number line, we have infinity dollars, and the reason why is because Ethereum can constantly go up. Now realistically, Ethereum is probably not going to go to $1 million per Ethereum token, and that's just because of market cap as well as I don't think there's that much money in the world. But with that being said, the liquidity pool does not factor that in. The liquidity pool assumes that the price of Ethereum can go to any possible price point. That's just how automated market makers work. The question is, are people going to provide liquidity on those price points to allow it to happen? Now, if you're providing full range liquidity, you are allowing that to happen. However, if you're providing concentrated liquidity, chances of you providing liquidity for, let's just say, $1,000 per Ethereum to $1 million per Ethereum, very, very unlikely because your return once again is going to be very, very low. So what we're doing when we're concentrating our liquidity is we're essentially just selecting a few price points or a range of price points on this number line. So for example, our range could be something like $1,000 to Ethereum to $3,000 per Ethereum. That would essentially encapsulate the recent price points. It allows us to leverage up, but in a manner where we won't get liquidated, just where our capital is being used way more efficiently. Now, obviously, there are downsides to this. The downside to this is you do have faster and permanent loss. And I'm not going to dive too deep into what that means, but I will give you a basic understanding. So we use the same tool, Builder Metrics, and we provide liquidity on a price of $1,000 to $3,000. We go from earning 7% a year to 30% per year, which in my opinion, this is a pretty broad range. You're allowing Ethereum to go down 55% from current price and go up roughly 35% from current price. With that being said, if we hit calculate and permanent loss, you could see if Ethereum goes to the price of $3,000, we have roughly $56 of a permanent loss on a $1,000 investment, which is 5.13%. And essentially what ends up happening is as the price goes to the upper end of our range, so as the price goes to this $3,000, our Ethereum starts to get sold into USDC. And it's not just sold at the price of $3,000, it's sold constantly as the price moves. And that's because remember, people are trading their USDC for Ethereum. So they're taking our Ethereum and they're giving us the USDC, which is why this happens. So impermanent loss essentially represents the difference between if you just held your initial assets, not in a liquidity pool, but in your wallet, as opposed to being in a liquidity pool and actually getting sold around into the two different assets. Now, our hope is that the fees are going to outweigh this impermanent loss. This 30% APR, we're wanting this to actually outweigh the difference between if we just held as well as the amount that we have in the liquidity pool. Now, same thing goes vice versa. If the price goes down to $1,000, all of our money will be sold into Ethereum and it will constantly be sold. Because remember, people are putting Ethereum in the pool, but they're taking out our USDC. So with concentrated liquidity, we're essentially choosing a range just like this one, where essentially we can enhance our capital efficiency because instead of providing liquidity on every single possible price point on this number line, which remember is $0 to infinity dollars, we're ranging down and we're allowing our capital to only be placed on the price points that we think it's going to be used. And to put that in perspective, here's another example. If we're providing liquidity on the price points of $1,000 to $3,000, and let's just assume that there's 2,000 price points right there, and we have $1,000 of liquidity. That essentially means that we're putting 50 cents on each individual price point. And the way that we get that is we do $1,000, which is our liquidity deposit, divided by the amount of price points that there are, which is, let's just assume 2,000. So that's roughly 50 cents. Now the thing is, if we have 50 cents on each individual price point and the price point is not touched, then that liquidity is not used, which means if Ethereum trades between a range of, let's just say 1750 to 2250, then all of our liquidity from $1,000 to 1750 is not being used, and all of our liquidity from $2,250 to $3,000 is not being used. Because remember, our liquidity is only used if there is trading volume and fees paid on the price point that our liquidity is on. Which is why if we do disperse, say $1,000 across these $2,000 worth of price points, if it doesn't hit over here or it doesn't hit over here, that liquidity all the way over here is not being used. That is inactive essentially. Yes, it's in the pool. Yes, it's ready to be used, but it's not being used. And then you could start to structure your ranges in a sense where they allow you to dollar cost average or where they allow you to get a good return and you're basing it off of market prices. So I personally don't think $1,000 to $3,000 per Ethereum would be appropriate for a liquidity pool. Yes, it's getting 30%, but the thing is, it gives us a lot more downside exposure than upside exposure because we're allowing Ethereum to go down 55% and only go up 35%. That would mean that we're ultimately bearish on Ethereum. And with how the market has been recently, I'm not bearish on Ethereum. So I'm probably going to adjust my range to something like this where I have 1870. The reason why is because I want to encapsulate these price points right over here, these lows that we recently seen. And then instead of $3,000, I might do something like a more short-term goal like 2650, which would still allow Ethereum to go up roughly 20% from here, but ultimately it's a more short-term goal. And then when the price does go to say 2400, I might bring my max price to something like $3,000 or even $3,100. And as you can see, with the range of 1870 to 3000, we're still making 64% a year, which is not bad at all. With our previous range, 1870 to 2650, we're making 86% APR per year, which is really good. Now, that being said, that's going to wrap up today's video. Remember, if you want to learn how I made over $9,000 in the time span of just 1 month, drop a like and subscribe. Additionally, for those that just stuck to the end, we do have resources available if you want me myself to help you personally with concentrated liquidity pools and help you succeed. We have a one-on-one program where we give you access to comprehensive education, weekly one-on-one calls with myself. We walk you through our 5-step roadmap, as well as you have access to our private investor group with a net worth of over $100 million. Mitchell, Ryan, and Angela have all seen amazing results, with Mitchell making over $500 per day in this current market. The link to apply for that program, because it is application only, is going to be down below in the description. Check it out. If you like what you see, click the apply now button, hop on a call with myself directly. I will say that opportunity is going to come at a higher cost simply due to the fact that I work with only 10 individuals every single month and we have hundreds of applicants every month. So if you aren't really ready to commit a multi-$1,000 price, I would recommend you take a look at our Uniswap V3 mini course, which is only $35. It's linked down below in the description. It goes over the 4 fundamentals of Uniswap V3, like what Uniswap V3 is in depth, more in depth than what I talked about in this video, as well as how you can find high performing pools, how you can find the ranges for those pools, and how you can rebalance your pools to minimize that impermanent loss we were talking about. I'll see you guys in the next one, and peace out.